Well, good morning, everyone. And Gary, thanks to you and the people at ICI for doing this. So we've got a fast-paced session here. I'm going to cover a lot of things, and in the future, we're going to drill down on some of these topics. So the first thing we really want to talk about is just, if you look at just a high-level overview of the world, Canada is looking pretty attractive to the world from the outside. And even, I don't know if you watch the markets overnight, things are very, very uncertain. So generally, when you look at Canada, we have less problems than most countries. We've got strong banks, a good diversified economy, and rich in food and resources. So in an unstable world, Canadian apartments look very attractive. I mean, we've been through the 2008, 2009, a pretty rough recession, pretty rough on real estate, but there was no hiccup in the apartment sector, and that's made our sector, I think, just very, very attractive to Canadians to invest in, but also for foreigners to look here. Now, if we're going to talk about apartments, you really have to, you have to talk about the Canadian apartment universe. And the slide on your screen are the number of apartment buildings in the 11 largest cities in Canada. So just bring your attention down to the bottom right-hand corner there. So in the 11 largest cities in Canada, there are 109,000 apartment buildings. Now, that's interesting enough. But what's really interesting is just above it there, you can see that Montreal has 56,000 of those 109,000 buildings. And you can see there in this column right here that 30,000 of those buildings are just very, very small buildings. So 109,000 buildings in Canada. But let's think about, what do major investors want to buy? Well, major investors are going to want to buy bigger buildings. So we've broken this down, and you can see here this column. These are all the units that are between 50 and 199 units. So in all of Canada, or in these 11 cities, there are 701 buildings 701 buildings over 200 units. That's the category we want to look at. And you can see that Toronto has half those buildings. So if you think of this category, these 200 plus buildings as institutional quality, there are only 700 of these in the 11 largest cities in Canada. So every time one of these buildings gets sold to an institution or a pension fund or a REIT, that basically comes out of the market because they're not going to retrade them again, right? So the point I'm trying to make here is that when you invest in apartments in Canada, it's a very small market. And even if you go down to the category now between 50 and 199 units, you can see that there are 4,000 buildings in Canada. The majority of buildings, of course, are in the smaller category here. So Class A large buildings are in high demand in Canada, and there aren't that many of them. So if we look at these larger buildings, see Toronto has 363, Montreal has 96, Ottawa has 69, and then you see the number drops off quite dramatically, right? Quebec City only has 11. So I think Gary is going to make these charts available to you guys after the session, but this is a very interesting chart, and one of the things I always say to people who want to buy apartments is you can only buy apartments where there are apartments, right? And so the apartment universe in Canada should be driving any decision that your client, or if you're a broker or you as an investor are making, that you can only buy apartments where there are apartments. Now, if you look at sort of investor demand, certainly since 2008, 2009, buyers have returned to the marketplace. Interest rates are low. We're going to make more comments on that a little bit later. And cap rates have compressed. And I think it's fair to say that in the last 6 months, there's been a shift in the marketplace. Cap rates have definitely moved down across the country. And we're seeing sort of a shortage of quality product. There's a flight to safety. And I think Canada looks pretty good in the world. And foreigners are coming here now to buy apartment buildings. Certainly, if you want to make a higher yield, you can go to the U.S. But when you're looking for safety, Canada is the place to be. Now, I've tried to show here on this chart sort of how the marketplace has moved in the last few years. So it's for sort of a high-level graphical presentation here. So let's say in 2007, prior to any problem with the economy, there's this normal gap between the buyer and seller. And let's just call that gap 10%, right? So prices are rising, and there's that 10% gap. What happened in 2008 and 2009 when the recession started was that the buyer expectation changed. So buyers said, we're sitting here on loads of money, we're waiting for the deals to come. Now, most of you know those deals never came. There were very few distressed properties in Canada. I mean, we sold one building in Windsor, and it just was a really strong economy. Interest rates stayed low. Our unemployment went up, but apartments still stayed full. So people were sitting there on the sidelines saying, we're waiting, we've got cash in our pocket, we're waiting for the bargains, and they never happened. So that gap between, what the seller wanted for his property, which didn't change, what the buyer expected to pay, got wider and wider, and transaction volume went down pretty significantly towards the end of 2008 and through 2009. So then really the question was, who was going to blink first? Was the seller going to drop his price, or was the buyer going to, come back to the marketplace? And that's clearly what happened. So in 2009, 2010, and going into 2011, from this graph, you can just see that, prices sort of continued up, and we've sort of gone back to that spread of buyer and seller expectation, and I'm just using 10% as a number, but I think it's fair to say that in 2011, the marketplace has sort of returned, and it's the buyer that's moved up and said, if I want to buy an apartment building, then I've got to pay the higher price. So let's talk about cap rates. The people at CV put out a quarterly report on cap rates, and you can just see what they're showing here. And I don't really want to sort of agree or disagree with with the cap rates, but I think what's interesting to look at is the trend, right? So the trend is clearly down in most cities, and in some places they've got it going sideways. And so cap rates are definitely moving to the to the seller's advantage. There's been compression in cap rates in the last 6 months, and interest rates continue to move lower. You could probably expect a compression in cap rates again. I think what's interesting to note here is that the difference across Canada has equalized. I mean, Toronto always got sort of higher cap rates than than Montreal, significantly higher. But I think as you go across the country, especially in Class A product, there's maybe not such a big difference in a Class A between Toronto, Montreal, Ottawa, Winnipeg, Calgary, and things like that. So there's been that leveling out across the country. But clearly, I think it's fair to say that cap rates have gone down, and they're tied to interest rates, and so we expect that cap rates would continue to drop. In terms of the capital markets, I think it's fair to say that funding for apartments has readily been available. There's increased interest in this sector, certainly for the best of class product, and I think CMHC financing gives apartment investors a real edge in Canada compared to other countries. The 5-year mortgage is probably around 2.5% right now, and the 10-year mortgage is about 3.5% today. And so you think about that spread of even if the cap rate is 5.5%. If you've got 10-year money at 3.5%, that's a 200-point spread. That's pretty attractive. So I think that's going to force cap rates to continue to compress, and making deals tougher to do. Certainly in terms of underwriting, I think this the banks are starting to recognize, and CMHC is starting to recognize, that cap rates have moved down. We certainly see this problem occurring in new apartment construction, where people are buying. I'm going to show some transactions we've done a little bit later on, where cap rates are 5.5%, and the bank's only recognizing a 7% cap rate. And the people at CMHC said, listen, we don't want to create the market. We want to sort of follow the market down. So as more and more deals happen at these lower cap rates, lenders will start recognize them. But I think right now cap rates are still playing catch up in the lender's eyes. So historically, low cap rates are enhancing return. The debt is there to support it, and there's a good spread between cap rates and interest rates that are just making apartments more and more attractive on a go-forward basis. So the question then becomes is, if interest rates go lower, I don't know how they can go much lower, but let me just ask you a theoretical question. I don't know the answer to this. If interest rates went to 0, what cap rate would you pay? I'd be interested to see if anybody has an answer to that question.